Welcome to the 300th episode of the Truth About Real Estate Investing show. I am shocked. If you're new to the show, that is one episode per week since March 2016 when we posted our very first episode, which was part of a 6-episode experiment, which is a very long time ago. It feels 7 years ago. Each interview is about an hour long, and if you were to go back and try to consume all 300 episodes, that works out to about 12 and a half days, which I do not recommend to consume all 300 episodes. I personally listen to almost everything audio on usually at least 1.5 times, so you can probably get through it faster than 12 and a half days. Greetings, my fellow investors. This is the Truth About Real Estate Investing show for Canadians, where we bring you the truth and nothing but the truth. We're not interested in peddling get-rich-quick schemes or hyping up unrealistic dreams. Instead, we provide you authentic, successful real estate investors, leaders of industry with authentic insights, practical advice, and invaluable lessons from experts who've been through the ups and downs of real estate investing. This week is no different. Our guest is Nick Karadza, who co-founded and co-owns Rockstar Real Estate Brokerage with his brother Tom Karadza. Unfortunately, Tom's feeling under the weather. He's losing his voice, so we'll rebook Tom for a separate date. But the show must go on. Both Nick and Tom are mentors of I to Cherry and I. Their business includes running a real estate brokerage, specializing in real estate investing to service other businesses, and also service other businesses, which is like the Rockstar Inner Circle, a real estate education business that offers amazing value to its members. I know because I've been a member since about 2010-ish. The monthly fee is only $50 per month after a small initiation fee of $500. However, my referrals do get 50% off the initiation fee using my discount code, all caps, Erwin, ERWIN, all caps. Education is an investment. Good value is good value. And all good investors comparison shop. Gym memberships cost more than the Rockstar Inner Circle membership, let alone playing golf once a week or once a month. So get educated first so you can learn how to get rich slowly in a very safe manner in real estate so you can afford that golf membership. Remember, that is the dream, that passive investing pays for the niceties of life and for living. I'll never forget the first significant nice thing Cherry and I bought for ourselves, which was a hot tub, paid for when we refinanced a duplex that we'd held for several years. As a frugal investor, we generally don't spend much on ourselves, and because we know what kind of returns we can make when we reinvest money into our real estate portfolio. If I look back at what our clients purchased in May 2013, which is just 10 years ago, again, May 2013, 10 years ago, our clients were paying an average of under $300,000 for detached properties, houses. And on average, those houses appreciated, if you're sitting down, maybe be sitting down, those houses appreciated on average 260%. So assuming a 20% down payment, and for the simplicity of math, we'll exclude cash flow and mortgage pay down. These properties did cash flow as the highest best for that time and period and neighborhood in town. The highest best use for those investment properties back in 2013 was student rentals. And those houses, again, assuming 20% down, our clients averaged a return over those 10 years of 800%. Yes, again, this is data from properties our clients bought, so we know exactly what they paid for and the addresses and everything. And because we're active, I have a pretty good idea what those houses are worth today. With all the international students in college, and all the international students the colleges and universities are recruiting, student rental business has never been better. Note that our college and universities need international students, as their tuition is not capped, unlike domestic undergraduate students. So it's for anyone reading the news, funny enough, a lot of the liberal media, which is generally the media, leaves out the fact that prices are capped on domestic students. Hence, Guelph was in the news just recently that they're having trouble balancing their budget, even though they have a good number of international students. Anyways, the government should have seen this coming. So there's international students, and those folks are making up a humongous percentage of the people that live in Canada. most recently, and housing has not kept up. So our investors are benefiting from the complete imbalance of over demand and under supply. The benefit of being a long-time investor is, the market is our friend. Same as cash flow, which allows our smart investors to weather times like today, where we have elevated interest rates, so they can weather the storm. Unfortunately, there are many who are over-leveraged or who speculated. So we'll be seeing more listings hit the market over the next 12 months until we see an interest rate cut, which is looking like mid to late 2024 next year. Once we see a cut, that will be a signal to the market to get in, and we'll likely see a whole bunch of people who've been sitting on the sidelines get back into the market. I'm talking about specifically for buyers, pushing us from a balanced market to a seller's market. And I only generally observe the markets that we invest in for target investments. So that's generally well east of the GTA and well west of the GTA, where we can actually cash flow on property. From what we're seeing on the streets, good quality income properties still draw multiple offers. For example, a property in Hamilton, Ontario that ticked every box. That property still drew 5 offers. Unfortunately, we lost on that one. While smaller markets, such as like Niagara Falls or Belleville, Ontario, and especially really small market like Trenton, Ontario, the showing traffic and offers is way off, as in dropping low. Same thing with the tenant applications, and so and based on seasonality, they'll trail off further as we head into summer. So what does that mean? If you have a property to sell that's bleeding you money and no longer serving you, if it's my client, I'd be advising them to get aggressive on their pricing, as buyers are rightfully being picky. Buyers who waited patiently and prepared for a fearful market, you probably have about a 12-month window before that rate cut happens, maybe a little bit longer, and then we flip back into a seller's market. And that's the long-term trend, because we are in a housing crisis. Nothing has changed. Long-term quality income properties will still be a winner. So make sure you only own winning investment properties. And if you're unsure, reach out to us and we'll let you know. I'll let you know. That is if you want to work with if you want excellence on your real estate investment power team that delivers exceptional results. In last year, in 2022, our clients' properties sold for 19% higher than the average comparable properties. These are clients' properties that we listed for our clients. I believe that's an indication of that our clients bought right. They renovated for a return on investment, and honestly, we believe in being excellent at what we do. You heard earlier that our clients from 10 years ago achieved 800% return on investment over 10 years. Of course, past does not predict the future. I do not think the next 10 years will be nearly as profitable, but I do not see a better investment. And there's also a reason that we have 50 5-star reviews on Google, as we are here to set the standard for performance and client satisfaction here at iWin Real Estate. If any of that interests you, let's get on the call. Email us at iwin@infinitywealth.ca, and let's understand your goals, determine a strategy, get you where you want to be, via the remarkable venture that is the world of real estate investing. And we're only talking about truths here. But enough about our clients. On to our 300th interview with Nick Karadza. Nick is a real estate investor who discovered the power of leveraging real estate through boot camps, starting at age 21. That was a long time ago. Nick's an old friend, so he is older than I am. So 21, when age 21 was a long time ago. He bought, renovated, and flipped properties for profit, but realized it wasn't generating the desired cash flow to replace his job income, and it was a lot of work. To flip a property with your own hands is a lot of work. Nick shifted to rental properties, achieving monthly cash flow and recouping his investment. Nick founded Rockstar Real Estate Brokerage, Inc. and the Rockstar Inner Circle with his brother to assist real estate investors. Nick publishes a newsletter, shares online articles, teaches classes, hosts events for their 1,000+ Rockstar Inner Circle members. That's a paid membership. And also, Nick co-hosts with his brother the Your Life, Your Terms podcast. I'll have links in the show notes for all of this, of course. Nick remains an active real estate investor. He consumes an endless amount of economic news and collects some gold. Wow, Freudian slip. not golf, gold, and Bitcoin. Please enjoy the show. Hi, Nick. What's keeping you busy these days?
Oh man, everything. I got to study. We're in a world where you have to be an economist to understand what's going on, to try to figure out what your next moves in life are. So it's like constant studying of, different markets. We're always asked what's going on in real estate. Hey, what do you see? What do you think's happening with interest rates? What do you think is happening with this? So that's what keeps me busy and tied to maybe my phone, looking at different articles and stats more than I want to. But outside of that, we got family, we got the gym, we got, we've got a little bit of everything. Try to balance things as best possible.
Yeah, you're actually a lot. So I think the listener knows I've been part of Rockstar since 2010.
Was it 2010? I remember, man, I respected you. You came into the office. We didn't know each other.
No. I knew you because I read up on you. I read your book. I read through your blogs.
Did you? Because we didn't. I don't even know how much stuff we had out at that time. But I guess because we started a few years before that, so there would have been some stuff that we had written online.
Quite a bit.
But you brought a Napoleon Hill book, I think, or was that the second meeting?
That is a big one.
Yeah.
Yeah, it's one of his big.
Yeah, you brought that. Yeah, and. Yeah, good conversation. I don't know, just got along with it. Yeah, I was just like, he seems like a good guy. Yeah, back then, I mean, it's weird. That's it's a weird barometer to use, right? If you like, oh, we should do something with this person. Like, they seem, whatever quote unquote normal is to you, right? And do they seem like a good person? And that's like, the barometer these days. For me, that's how I make a lot of decisions. And I don't know if that says something about me or the society in general, that sometimes it's harder to find good people than you would think, if that makes sense. But anyways, yeah, it worked out.
Yeah, it worked out. I did bust my ass on my marks though. I don't. To me, it was important, but like my average for the OREA course is to become a realtor for the listener's benefit. Like, I think my average was like 96.
Oh, mine was like the second exam. Well, were you open book or did you have the multiple choice?
I was close. Yeah.
Okay, so
multiple choice. Yeah.
Oh yeah, okay. So we had short answer open book. So the first one I studied and I did pretty well. I forget what I got, And then the second one, I was like, well, it's open book. I mean, I'm not going to study. Well, why am I going to study? I was like 21 at this time. I was just getting into buying some of my own properties, right? And I was, well, I'm not going to study. So I just showed up with the textbook to write the test. And this one was way more, it was all about the real estate law and that type of stuff. I'm like, I don't know any of this stuff. So then I was like, I'm flipping through the pages. I'm trying to write as long paragraphs as possible, trying to get part marks like I was in high school.
Excuse me? You had to write paragraphs?
Oh yeah, man. It was all short answer and stuff. So I had to do that. And I remember that second exam, I think at that time the pass was 75, if I remember correctly. Yeah. And I got the 75 right on. So yeah, I'm not going to compare marks with you.
Oh no, like after I realized like none of it really mattered. When I got into my articling, it just passed. I was busy. I was busy with doing business, doing deals.
Yeah, sure.
And then I had to do the articling test. But I just passed the law one.
Yeah, it's those ones where it's like just random stuff. Yeah. But I don't know. I don't even know what the full process is now. I think it's. So I know a couple of people in the office actually going through it, so I could probably ask them, but I haven't got a chance to. Actually, someone today is in the course. Actually, some at the office right now.
It's a lot harder than it used to be, but yeah, it worked out. Yeah, I always refer back to this picture from my first team event at Rockstar. We were at the rock climbing.
Yeah, I see some of those. We have one of those on the wall, I think.
Yeah, we do.
Oh, the rock climbing gym.
The rock climbing gym.
Oh, I thought we were rappelling, but the rock climbing gym was we built a pyramid.
Yeah, a human pyramid.
Yeah.
Because the team was small enough to do it.
Yeah. And then didn't we fall on each other at the end of it?
I think we did okay. I think we couldn't get the person at the very top.
Okay, that's where it got sketchy.
It got sketchy, but I think the picture is a great analogy for my career at Rockstar, because my knee is in Tom's lower back. So I've always been a pain in his back.
Oh, jeez.
I was smart, though, because I looked at everyone around like, oh, people are pretty fit. And I don't want to be on the bottom row. So I was on the second from the bottom row.
Oh, man. It's funny. We still get some people that have been with us since then. And they're like, man, it was so nice when it was just that really small team and stuff. And I agree. There is something to be said for that. It was nice, right? Mm-hmm. But it's nice now as well in a different way. But so depending on who you are as a person and what you like, it might be better or worse, depending on. But But we're still a pretty close-knit group for the most part. We're fortunate that way,
Right.
which has been nice. As part of the process, I feel like I don't know, from the outside, maybe the people working with us won't see it the same way. I don't know what you think, but we've tried our best to make it feel like a more of a real team, a little bit of a family versus just like a bunch of faces and people coming and going.
Yeah. A true team family culture versus people slap those terms on anything.
Yeah.
Like obviously it's harder for like 1,000-person organization. But something that I've always admired about you and Tom was that you were always not afraid to scale up, but you did it as controlled as you wanted. And also, for example, like you could have had multiple franchises outside of the office, but you chose not to.
Yeah.
So it could have been a lot bigger, but you chose not to.
Yeah. I mean, there's a good and bad side to that for sure, right? Have we left opportunity on the table? Yeah, for sure. We've been asked to open franchises in different parts of Canada and things like that, but part of that would require management of those. And with young kids at home, now the kids have gotten a little bit older, but with young kids at home, we wanted to make sure we had time for the family, and we had already been traveling a lot to different conferences to just enhance, our own skills in marketing or investing, or whatever it might be. But to then manage things in different time zones and different areas, I don't know if we wanted to take away from our personal lives in that capacity. And we know we gave up some opportunities for that, but I think we're comfortable with it. Mm-hmm. But the flip side of that too is, we gave up some opportunities, but we've saved ourselves a lot of stress, because at the same time, we would have had to find people to operate those for us. And it's really not easy to find, well, I mean, you and Cherry are both business owners, you guys get this, like to find good people is not easy. And, very often in real estate or in other professions where there's a big financial incentive on a sale, insurance comes to mind. I'm not picking on insurance people, but I know for some life insurance policies, there's a hefty commission to be paid depending on the size of the policy, right? So sometimes those incentives will cause people to force a sale where there might not be a sale to be made there. And I know, everyone's heard, the stereotypical horror stories about realtors, but, some people in real estate and again, other professions will chase commissions, and we would never want someone under our name chasing a commission. I think it brings us anyone that's part of the company, it would bring all of us down, because that's not how we operate. And I guess that would be a concern for us, so you always got to find good people. And I know you over time, how many times have you talked an investor out of buying a property because you felt that you could find them something better, right? So, but there's a lot of people that'll be like, oh, you want this one? Okay, no problem. Mm-hmm. Let's write up the offer. They're chasing that commission, mm-hmm. versus saying, hey, okay, I know this one seems good, and you're anxious to go. That's cool. Let's back up for a minute. Let's not buy this one. I can get you something better, and you're putting your word and your effort on the line to do it for them. And I think that that makes a difference, and it's what's allowed you to build your business a certain way, and to have your client base around you for so long and loyal to you because you kind of watch out mm-hmm. for them. So it's the same similar principles that way, I think.
If you remember Margaret, a longtime Rockstar member.
Yeah, I remember.
I exactly that. We're looking at properties around McMaster.
Yeah.
And there's a lot of properties that are a dog's breakfast.
Yeah.
But for someone who's new to that market, they don't know, So what for example, like my original portfolio, I had a house that was built in 1880s.
Yeah.
Right. So the foundation was logs. It was literally logs.
Really?
Yeah.
I haven't actually seen that before. We have one that's stone. It's like crushed stone all put together, but not logs.
Yeah, I had logs.
Wow.
So every time it rained, water went into the basement and dirt floor. Anyway, my point was that I didn't have much context what a good deal looked like.
Yeah.
So for example, once I joined Rockstar, I would before I was working with clients, I'd go once a week to go look at everything that fit my client's profile, right? And so, for example, once someone sees 100 houses, now you kind of know what the top 20% looks like.
Yeah, you get it.
Yeah, you get it, right? And so, if you're that's my strategy. I want to own a top 20% property, rent to the top 20% of tenants. So exactly with Margaret, I had exactly that conversation. She'd be interested in a property. It's no, we can do better. Mm-hmm. Too many bedrooms are small. It was sided, And for that neighborhood, a lot of houses are sited, they're just hiding problems, right? So I wanted something more, less old, better home construction. So like at least 3 times out. Took her 3 times out. It's like, no, we can do better.
Yeah. Yeah, we learned that the hard way. One of our early properties that Tom and I bought was by McMaster. And we just looked at the numbers. And the numbers looked good. Remember the 1% rule?
Yeah.
There was a time when that was like a rule that, and there's some places.
Yeah. Easy with student rentals at the time.
Yeah, for sure. Yeah. And so the numbers looked good. And we're like, oh, we should proceed with this property, not taking into account a lot of these other factors, or once these tenants left, what it would have taken to get it up to par with the other properties in the area, to maintain that revenue stream and things like that. And it was just an early lesson for us. Like, we were blinded by the numbers. This was literally, I think, our second or third property. So it's very, very early. And we were, so focused on the numbers that we just didn't take other things into account. And we own that property until today still. So it's worked out very well for us. But at the time, we just were like, oh, we actually probably, we overpaid for that property, and we could have got a better property for the same amount of money, but we made it work. But it's an early lesson, right?
Mm-hmm. Do you remember the year?
The year that we bought it?
Yeah.
I would have been, it was probably about 20 years ago, something like that. Yeah, I don't know exactly how long we've had it.
Do you remember what you paid for it, roughly?
Yeah, I want to say $250. I don't think it was $230. I think we ended up paying $250, and we should have paid probably $220 or $230 for it. It's, if by today's standard, knowing what I know now and that lesson that we learned, we should have paid a little bit less for it. But it might have been as high as $250 or $230. But the guy that we bought it from, get this, he had owned it for a number of years, a decent amount of time. I forget how long, but he had only ever put an interest-only mortgage on it. So he had bought it for, I think it was like $50,000 or $60,000, and he had only ever put an interest-only mortgage and renting it all this time, and then he cashed out.
Good for him.
That was his process. So it sounds funny, but it went up. It must have been about $50,000, and we paid $250 because what we laughed about it, saying, or $60,000, and we paid almost $250 because we said, okay, so if his multiple went up 4 times, or roughly 4 times. And in this amount of time, we were joking. We were calling it the $1 million student rental. So like, this property is going to could be worth $1 million one day. Like, we know it sounds ridiculous, but with what was happening with what's happening with rates and the financial system and money printing, if they're going to inflate things away, this could be $1 million property. And we kind of all laughed about it. We would talk about it at team meetings. I remember back when we were in the Burlington office, we would be laughing about the $1 million student rental. That property is not worth $1 million today, but it's not that far off. And if the last tenants have been there for a number of years now, because always a couple stay, and so we can't raise the rents back to market because there's always 1 or 2 that stay, because we just don't usually rent when we don't raise. I know you can't raise much. We don't even raise on student properties if they stay, because they're only usually there for 2 or 3 years. But they keep backfilling with people, so it's easier for us. But then we haven't raised the rents again. So I don't know what it'd be worth today, but it's not quite $1 million. But we're on our way there. Like, the joke that we made all those years ago is actually coming to fruition now.
How much did you understand about economics 20 years ago? Like money printing and
not much.
The amount of debt that the government goes into. And
2008 is when we got serious about that, right? Because after that financial crisis, we looked around and we said, "What the heck just happened? Like, why? Like, what's going on? And why do we have no idea how this stuff works?" And that's when we got serious about trying to understand that financial system. It was weird when that financial crisis hit in the fall. We were in the U.S. at a mastermind meeting, and Americans up to that point, whenever we were in this part of this group, they're very aggressive. With their moves in real estate at that time, they were just, everyone was just almost all in.
Huge portfolios.
Yeah, they were they were all brash. I don't mean that in a bad way, but they were just very confident, very just outgoing, we're gonna crush this. Nothing could stop them. There was no barriers for them.
Good Lord, that sounds familiar.
And then when that financial crisis hit, we were at this meeting, and I'll never forget. We went down that one morning. I was like, "Did you see what happened? Did you see what happened?" And it was just fear in their faces, and we're just like, "What's going on here right now?" So, and that was the start of all that stuff. So that's when we got serious, that we had to try to a little bit understand this and kind of go deep, because it was starting to really impact our everyday lives. And we're like, if this impacts our everyday lives and everything we do, why do we not understand it at all? So that's when so 2008 was when we really got into it.
For the listeners' benefit, what happened to your associates in the U.S. who had built up large portfolios in the run up to 2008?
A lot of them had to walk away from them. Yeah, a lot of them had to walk away from them. They were very, very highly leveraged, no focus on cash flow. Only focused on appreciation and just acquisition as much as possible, and it put them in some bad situations. We do know some people that started to do some what they call strategic defaults. So they would even hold on to the property for a period of time at that time because they knew the bank was going to take a while to come and foreclose on them. So they weren't paying the bank, but they were collecting rent. So they were using that as a stream of income, and then they were walking away from the property afterwards when the bank came to foreclose on them finally. So because they were just like, we're finished anyway, so this is what they're going to do. And then they've since, I mean, one guy that comes to mind particularly has since rebuilt his portfolio, changed it a little bit, definitely focused on income and cash flow versus just kind of acquisition and appreciation, and has looked back and been like, wow, I really kind of didn't understand what I was doing before. Now I'm really kind of got a narrow focus on what I'm trying to build. So it's changed for them, but I think it woke a lot of people up. There was a lot of them went through, some some turbulence there for sure. Dark times is probably a better term. Yeah. I don't want to say dark times is better than turbulence. Yeah, it was rough for them for sure.
Because even mutual friends of ours, like they had, I know, like in Florida, they had like 100 property portfolio in Florida during 2008.
Yeah,
like they must have been really unhappy.
Because they were, when there's no income associated with it at all, and you're not taking that into account, it gets really tough. What was interesting that happened on the flip side is some of even the hardest hit places, rents almost didn't move, even as property prices came down, a lot in some areas. Rents almost didn't move, and in fact, even though they might have adjusted downwards slightly initially, they then ended up turning upwards because from the amount of people losing their homes, they needed rentals afterwards. So the demand for rentals increased. So anyone that bought with certain kind of fundamentals in mind actually didn't end up doing too poorly through that. They were able to hold on to their assets and continue forward. So that was interesting to me, and it's something it's a lesson that I've always taken back to our area because we're in a rent-controlled area. So we don't have rent control. Because of our rent controls, our rents are held artificially low, right? Overall, I know when people move out, we can put it to market rents, but overall, as a rental market as a whole, because we have some people that are well under market rents, there's downward pressure on our rental amounts, and we've seen this at least in the past as well, that the rental market has held strong even during times when things have kind of not looked good for the real estate market. So COVID's a good example, right? That people were still paying the rent because that was one of the first things they had to pay. Rent, actually, the percentage of rent increases for a lot of REITs actually increased for the rent payments. So it's something that we look at and we're like, yeah, I think that if that lesson holds true, and I don't know if it ever would or not, but if history is an example and using them as an example, that it's good to know that if you buy a property now and you can rent it out for X number of dollars, the chances that you can rent it out for X number of dollars in the future is very, very, very strong. And that might be your worst case scenario for the income it can generate. And there's other variables to that for sure, but it's good to know that, if you believe that, and then you can base your calculations off that.
So having personally, even though it wasn't your own portfolio that was getting decimated in the U.S. in 2008, you kind of lived it. You kind of lived vicariously through others to go through that.
Yeah, but we, from afar, we were sheltered.
Yeah. Well, I know. So that's kind of where I'm trying to go to, is that you had property, you owned property in 2008, and you had clients. What was that like? What was your experience like? Because back here in the GTA.
Yeah, well, so our clients at that time, many of them were able to pick up good property. Like in hindsight now, looking back, but they were doing it at that time. They were taking advantage of the opportunity to be able to negotiate with builders even and ask for extra things they weren't getting before, or negotiate different deals or better terms on deals. So they were using that to their advantage. But the majority of our clients and the investments that we do, they're all long-term. So that was then an opportunity for people that had a certain time frame of investing. Whereas I find when the market really starts to, overheat or get really hot, or it's just real estate spoken about everywhere, it's the short-term prices of what everyone focuses on. But that wasn't the focus for anyone, so it turned into a really good opportunity for them, because they weren't worried about, if they bought in February, they weren't worried about what the property was going to be worth in May. They were worried about what the property was going to be worth, or what the numbers would look like in 3, 5, or 10 years from now, and that's what interested them, and that's why they were buying the property. Mm-hmm. So I think it was just a different mindset for the majority of people that we work with. But whenever there's a little bit of question marks or fear in the market, there's also a segment of people also that are just like, I'm going to hold off. And they put their hands in their pockets and they're like, I'm just going to wait and see what happens. And that's fine too. It's just two different approaches.
So I've been talking about how I because of the work I do, I speak to people from all different schools of thought around real estate investing, for example. And I think that Rockstar is Rockstar was the first place that explained to me why gold was a good, I don't know what the term is, investment, but savings plan. I don't know what the right term for it is. To explain the hardness for gold, and also the business case, why it made sense to hold some hard assets. Mm-hmm. And then if you believe in gold, you should in theory believe in owning real estate. But I think a lot of groups don't discuss that at all. So where I'm trying to go to is that also, like, you and Tom do a heck of a lot of research into economics, what governments, what central bank policies are.
How bad they are, you mean?
How bad they are. I think it was Tom that first mentioned like what the next currency might be. And like holy shit, where am I? Yeah. But you guys very much behave like you have a fiduciary duty to your 1,000+ client members, right? Yeah,
it's real estate has always been a means to an end for us. So it's never.
Oh, you don't enjoy it? So, you don't love being a landlord?
Well, yeah, it's not. It's just not even. So yes, but I have a friend that he wakes up every day, and he goes on the Toronto Real Estate Board and will look at listings like immediately. He's like, he goes, I'm drinking my coffee in the morning. I'm just looking at listings. Like he loves it. He loves it. This was even, but he recently got his license. This was before he got his license. He would be on just the public websites where you can get access to some sold data or the new listings, and he'd be all over them. Like he just loves it that way. That's never really, nothing's really spoken to me that way to where I want to do that every morning all the time. But
except the gym.
Yeah. But I still got to drag my butt to the gym. I'm happy once I get there. But some morning in the middle of the winter, man, I'm driving to the gym and it's cold and it's dark. And I'm like, why am I doing this at this time in the morning again? And I'm sore.
I thought you're just happy all the time. Gym time. Let's
go. No, once I get there, I'm happy.
For anyone watching the YouTube, like we do post it on YouTube, you'll see how Nick looks like he enjoys going to the gym.
Yeah.
It's 5 a.m. It's gym time, baby.
I do. Look, I go to the gym 6 days a week. I love it. I'm there
at 5 a.m.
Yeah, not anymore. I'm there a little bit later because what happened is that 6 a.m. class got so full that I don't do the class, right? I do my own stuff. So I kind of get in at 6:30 to start doing a little bit of warm up to about 7, and then I start working out then. So I do sleep in later now. But
but back to your friend's passion, like crazy obsessed.
Yeah, so real estate's always been a means to an end, right? So like our whole thing, which right? But our whole thing is the reason it's called Rockstar Real Estate. Because people, when we started, they're like, who would call their company name Rockstar? Like some other real estate companies. We're like, well, I don't know if you know the history of your name, but that doesn't make sense to us. But the history of our name, so you understand it, is just that we believe you invest in real estate to live your life on your terms, which we coined your Rockstar life, and that is whatever it is we want to do. And so that's the means to an end, is for some flexibility, some freedom of choice financially, whatever it is to live life on your terms. And because of that, we feel that there's more to that than just real estate. Now, real estate has played a very effective part in that for us and many people that we've worked with. It's played a very important role. So I'm definitely biased towards real estate because of that. But we feel that real estate doesn't operate in a vacuum. There's all these other factors that impact it. Now, right now is a great example, like the interest rates rises that we're seeing. That's a really great example of something that impacts us, and it's a great example of something that's impacted us for the last 10, 12, 15 years or so. When rates went super low, it was fuel onto the fire of real estate, and people that own properties or assets in general really benefit from those low rates. Now we're in this contraction phase, and then we see what happens in the future, but we have to understand that type of stuff. So no different than when we were talking about central banks and the financial policies and their fiscal policies, is that when you understand what's happening with the value of our currency or our purchasing power, and I know you know this, but I mean, you just realize, you're like, is it really the price of real estate that's going up the way it is? Or is it the value of your dollar that's going down? And when you think about it and you start understanding it, you're like, you know what? The real estate's not really going up. The real estate's the real estate. It's actually the value of your dollars going down. A great analogy that Tom used in one of his newsletters that he wrote, he took our parents' house, and our parents' house, they bought it for just under $100,000. We'll call it $100,000, right? And they bought that now probably about 40 years ago or so. So he put the $100,000 on the front lawn in $100 bills, put $100,000 there. Now you have the property. That was 40 years ago. You could fast forward to today. That property now, they haven't done too much work to it. It's some of it's original, but they have a new kitchen, some stuff, right? But they did, there's a pool. It's a 4-bedroom home in Mississauga, so that property is worth 1.5 or something. Call it, I don't know, somewhere in that range. Who knows? So, but we have the $100,000 on the lawn still, and we have the property. Over the last 40 years, what changed? The property didn't change. It's the value of that $100,000 that really changed. That's why it's worth $1.5 million of those dollars, right? And when you start understanding that type of thing, it's just like, holy crap, it changes the equation. And that's why there's a lot of people that invest in real estate, because
they understand the problem.
Yeah. It's a defensive move for them.
Yeah.
They're like,
now you understand the problem. Now we can find a solution.
Yeah, but they shouldn't have to, because we have this crappy currency. Yeah. So if you have 100,000,
we shouldn't have to, but we have to.
Yeah, exactly. But it's defensive. It's defensive because otherwise you get robbed of your purchasing power, right? But so it's this weird dynamic that happens. But so anyway, once we started to understand that, we felt it was very important, and we're like, we need to share this with people so they have an understanding of what's happening, and so that's why we went down that path. And when we understood it, and that's why we share that stuff, because people might disagree. Maybe it's not important to them, and they might be 100% right. We might be way off. But for us, it's very important, and that's why we share it, because we think it's part of a bigger picture.
And again, I don't think most people know this problem. Because if every Canadian understood this problem, there'd be more protests. Everyone would be pissed.
It's not spoken about, right? Well, they tell us, their official inflation rates, up until recently, it's hovered around 2%, but that's not the case. It's not the case. If you look at your grocery, if you look at the things
the grocery bill, very simple.
Well, look at your gas bill, like anything. I'm not take away the last 12 months or 15 months when inflation started going up. Take those ones away, and take the years that you've been told inflation is roughly hovers around 2 to 2.5%, maybe dips below 2 a little bit. Have your expenses only gone up 2% a year? There's no way in hell. It just hasn't happened. We took the average Toronto real estate price. We went back to 1969, and Kyle in the office grabbed these numbers. And this was up until September 2022, so about a year ago. So since then, the property prices probably went down a little bit and probably have come back. So we're probably at pretty close price level, so they're pretty accurate. But anyways, it's not going to be skewed much anyways, because we're going back to 69. The average price I believe it's 7.06% is the average yearly increase. I should go look at it again, but it's about 7%. So inflation, they're saying, is 2%, but houses are going up 7%. Right? Do you think the cost of oil, I don't have all the numbers in front of me, but I'm telling you, the things that you really want in life haven't gone up 2% a year. That's not the way these things have worked.
Cars haven't gone up like that. Cell phones haven't gone up like that. Laptops.
Well, the equation they use, do you know they use this replacement equation? So to do it, so like, so if they were using a T-bone steak as an example, or any steak, you know, say, well, you know, we have to, for groceries, we have to include some protein sources. So we'll include the steak. Well, once the steak gets too expensive, they're like, well, the steak's expensive now, so we don't need to include the steak anymore in our calculation of what it costs. We're going to replace the steak with protein still, but we'll just make it hamburger. Yeah. Right. So now it's hamburger. Well,
it's still beef.
Yeah. Well, yeah.
But it's not the same. It's not steak.
It's exactly. It's two different things. So now what? Like, what's next? You know, is it hot dogs next? Because I mean, are those beef?
All beef hot dogs. Yeah.
Are they beef though? I don't actually know all beef hot dogs. They say they are, but I don't know if they. You know, they don't look
parts of a cow.
They don't look like beef to me when I look at them. But yeah, you know, so that's the type of thing that happens, and it just.
But this is what you do if you're trying to manipulate inflation numbers.
Yeah. So so then you now. If you understand that, you're like, okay, so that's the game. So now we understand the rules of the game. Mm-hmm. So if we understand the rules, we're playing this game. It's very unlikely we're going to be able to change the rules in short time ourselves or whatever the case may be, right?
We don't have enough votes.
So then, yeah.
You've always been failing, so
yeah. Well, and you know, I mean, our leaders don't think about monetary policy. They come out and say that, like when Trudeau said that, you know, right? Yeah. So they're. Yeah, I'm not going to go down that rant. But anyway, but you understand the rules of the game, so then play within those rules. Like, are you playing the game to win or not? Because if you're playing the game to win, well, then you got to play within those rules and you got to exceed that.
At least play to defend yourself.
Totally. Like what? Like if we call real inflation, I'm just going to say 5% just for a simple number. If over the last 10 years inflation has been 5%, that means if you're not earning 5% on your money, you fall behind. So, and everyone that earns a 10% yield, which I think is like 10%, you know, as a decent investment return that people look for, right? So, especially when it was low interest rate environment. So at 10%, you think you're doing well, but if 5% of that is inflation, your real return is only 5%. So your hurdle rate is 5% for everything you do. And if the inflation number was higher, you know, where do you go? Right. So that's where, so I don't know, that stuff becomes super important. And I think it doesn't have to make the decision for you, but I feel really strongly that it should be taken into account with whatever financial decisions you're making, because it's not going away. It's there and we got to do something about it.
I'm always looking for like how to take advantage of information. So for example, if real inflation is 5%, and for the longest time we were able to borrow at 2 or 3%, mm-hmm. That's just math. That just makes sense.
Yeah.
To play the game of borrowing for cheap and trying to make better returns.
Yeah, until rates go up. Right, that's the downside. So you're right, 100%, because they need negative rates to inflate away the debt. So negative real rates, which means that if inflation's 5 and the borrowing cost is 2%, you take 5, you take the 2, you minus 5, you're negative 3%. Mm-hmm. So that's negative real rates. So you can arbitrage that, and that makes sense. But at the same time, when that flips like it has right now, the carrying costs have gone up, you do need the capital. You need enough liquid capital to get you through these times. Because if you over leverage, you're in a bad situation, right?
Which leads to something I was discussing before we were recording is I feel I can be impartial on things. Like I observe many investors, like Rockstar members, my own clients are Rockstar clients. Mm. They've fared extremely well in this downturn.
Yeah, overall, I mean, I don't like the cash flow numbers have been really squeezed for some people, and it's been harder for some people to carry the properties for sure. It's hit them, but overall, it seems to have worked out quite well. I think one of the things is that there was different people did different things, yes. but overall, there was never a focus on any get rich quick type strategies, and if you're investing for, you know, that kind of principles, you know, you're taking some kind of core principles or fundamentals into account when you're investing, it makes it easier to ride through some of these waves. Does it make it easy? No, I'm not saying it makes it easy, because there's some people that have, you know, a few properties, interest rates have spiked, they've been on variable rate mortgages with a bank that has adjusting their payments, and their cash flow squeeze, or they're negative now where they were, you know, thousands positive before. And, you know, so they have to ride through these times. But But it'd be a far cry if they didn't have that cash flow early on and they were just investing for appreciation or already negative, thinking that real estate prices only go straight up and only go straight up forever. And then they're in a much different situation. It also helps when you have assets that are, relatively easy to liquidate if you need to cash out. And we're seeing some investors do that. They're like, hey, look, the portfolio overall is doing pretty good. I just want some breathing room. So I'm going to take one of these properties. I'm going to cash this one out. Gives me a little bit of profit. Maybe that one was my least performing from a monthly cash flow standpoint. So it eases the burden there a little bit. I can cash out some profit and I'm in a good spot. So we're seeing some investors that will just unload like a part of the portfolio. Usually it's really just one property, and then it gives them some breathing room so they're in a comfortable spot again. But I think that's been the difference. Like it's the quality of the asset matters. Some people, like when the market over the last few years was just kind of jumping, you see people get into it, investors and just regular home buyers, they get FOMO and they're just buying anything. People will walk into a new home sales office and be like, well, here's how many condos you got here? Give me 3 of these condos. When are they closing? I don't know. How am I going to finance them? I don't know, but don't worry, you just give me 3 because the price will go up. I'll flip them or something. I'll figure it out then. And then they're just in a bad situation after, right? It's not uncommon.
They're probably in a lot of hurt right now.
Yeah, well, that whole market, yeah, there's going to be some pain. Like there's challenges to close on properties. Like some people are having problems with that, right? Also, it doesn't help that some people are fed that it's like a guaranteed profit source. Well, I mean, what happens, right? So, but it
just never made sense to me to buy a pre-construction condo when I can buy the exact same thing used and pay a lot less. It never made sense to me.
Yeah.
Unless that building is exactly what you wanted.
But
the location you wanted, the 10 out of 10, everything, except you had to overpay for it.
Yeah. Yeah, but the difference is people always think we joke that it's like we could sell, it'd be easier to sell people the magic code on the remote control that you can push in to have money spitting out of your TV than it is to teach them properly principle-based investing. Say, hey, this is the type of principle-based stuff that's worked for decades and decades, right? This is kind of like a path to follow. Yeah, there's some work. There's going to be work involved. There's going to be some ups and downs to it, 100%. But it's believable and it works. Versus the remote control secret code doesn't work and is almost not believable. But I'm telling you, people will buy that because that's what they're looking for. Everyone wants the easy button. They want the easy money, so they can get easily blinded by that message. If they meet someone that they feel that they can trust, that gives them that message, we've seen people do some really interesting things.
Because I know there's lots of condo specialist investors who have massive teams and that just sell hundreds of condos, probably 30 condos a weekend, whatnot. So I actually think there might be a glut of condo supply coming on the market.
I think there's going to be some challenges in closing. We'll see how it gets absorbed. But yeah, there's definitely that potential for sure. Yeah, I'm curious to see what happens.
Same here. Luckily, I have no skin in that game.
Yeah, I joke with everyone. I'm like, don't listen to me about condos because I missed out on that Toronto condo boom for the 10 or 12 years that it existed.
I mean, damn, trying to focus on cash flow. I know.
Well, I was so jaded. Like when I was young in Mississauga, they were growing. That's when the Square One area. Well, I mean, they're pumping buildings up there again, but initially they have built a bunch of buildings.
They're going to grow like crazy. They have to keep pumping them out.
So, but at that time, when the market turned in the early 90s there, some people that our family knew that owned condos there, those prices didn't rebound for a long, long time. And they weren't in a good spot because of it. And I've just always been slightly jaded by condos for whatever reason. I'm like, if the market turns, they get hit the hardest, usually the fastest, because you have the same unit as everyone else. So, it's the same, different, I mean, you can do small changes to it, but it's just different floors as the primary differential. And so I've just always liked things that I control a little bit more. So that's why I've always kind of moved towards that single family market.
On land.
On land, yeah, for sure. Well, that, and we didn't see it at the time, but over time it started to become very clear to us that buying these single family lots is kind of like a little bit of a land grab now. Because it's a lot harder to get into, grabbing land than it was 20, 30, 40 years ago because of the prices. When we had people coming here, I remember I grew up in the Mississauga area, so a lot of European immigrants were coming in, and some of them ended up going up to these smaller areas at the time, so out to, you know, the Georgetown, Milton, North Milton or whatever. And they were buying land, and they were kind of holding on to that land because they could at the time, and it worked out extremely well for them because now they're developing on that land and things like that. So to buy those plots of land now is not nearly as easy. A lot of it's institutional money that's buying that stuff up. So individual investors, a lot of a way to land grab is that single family building lot, because you can take a single family, put the second suite in it, put the garden suite on it. All of a sudden, you're now able to just increase the value of that thing. So we're seeing kind of more of that. And then I also like the single family. One thing that always stuck out with me is, you know this, I don't know if everyone knows this, but our family almost lost like everything in that real estate crash in the kind of late 80s, early 90s. Our dad was flipping paper. He was literally getting a property out of the trailer. They didn't have these big fancy sales offices. They were selling the properties in like a trailer, and he was getting the contract and flipping in the parking lot. And he got stuck with the place in Mississauga Road in Eglinton. It wasn't a starter home, and at that time it was a big luxury home in that area. And you know, it got stuck with it for a long time. Couldn't rent it out for cash flow. But basically, the stress from that, I think, definitely contributed to our parents' divorce. Like, it created a lot of problems in the family financially as well. And you know, it's always stuck with us because we always thought that if we wanted assets, that it'd be important to have assets that are in real estate that are as liquid as possible. And in the starter home category, it doesn't matter what the market is. If the market's super hot, if it's cold, if it's really expensive, if it's really cheap, whatever that entry level is in that market, that's where the most amount of transactions are always happening. So it's the most people are looking to get in, most people are looking to get out. So it's just a more liquid market. So if I have an asset, or if I'm building an asset base, just like the gold you were talking about, there's a demand for people to buy gold. I don't want to build an asset base of glass balls, because no one wants to buy my glass ball because they're everywhere. But I just know that if I have a liquid asset that people want in different markets, then that's generally the ones that I want to own. Mm-hmm. So that's why we've kind of always stuck with that market and gone down that path, or it's appealed to me a little bit more. But at the same time, like you said, you missed out on the condo, you know, craze in Toronto. I missed out on it too. So, you know, take it for the grain of salt. But I benefited from this one. So you can't have everything. I'm okay with it.
Yeah, I'm okay. I'm okay.
Yeah. You're not complaining. I get it. Yeah.
See, and so still single family home. That's still the basis of what you think investors should be going forward. Because, for example, before we're recording, I know you don't keep tabs on social media what other people are promoting, whatnot. But for example, like
zero.
Yeah, that's probably why you're mentally healthier than I am. Have more hair than I do.
I don't know about the more hair. That's for sure.
You guys have never really gone after any fad. Like, for example, apartment buildings are a really big fad right now. Airbnb, massive fad. Like, are any of these not that it's a bad, they're bad, not saying they're bad investments. I love staying in Airbnbs. Are any of these, you think, core investments you yourself would do or recommend to clients?
Yeah, no, like I would, 100%. You know, if I get the right property, would I do it on some short or medium term rental? Yeah, probably. We have that place up in Collingwood that we've got recently. It's still got a big pile of dirt in the backyard, and there's no grass or anything, so we couldn't even really short-term. I mean, we could short-term rent it, but it's not very appealing since you like just stay inside and don't leave because there's dirt and mud everywhere. But you know, would we look to do some midterm rental for that type of thing during a season when we're gone? Like the summer, we're in Europe for a chunk of the summer, and we're not going to be here to use it. Would we look at that? Maybe we would. So I'm not opposed to it, but ultimately, to me, it's the asset that matters the most. So I would look at the asset first, and then I would look at what strategy I can apply to that asset to make it successful. Yeah. Whereas I think sometimes investors are looking to get into the market and they're like, well, I want to do Airbnb, so I'm just going to go find a property that I can fit into that mold. And that's great. That's not a bad way to do it either. I just feel that if I get a good asset in a good place, then I can apply multiple different strategies to it. And that's generally what I like with investing. So if you look at the, so take one of the properties by, on the mountain in Hamilton, close to Mohawk. Well, there's a hospital up there. So, you know, you can rent it to some hospital staff, right? So there's always demand for that. There's Mohawk up there, so you can rent it to students that way. Right now, it was a rent to own initially, then it turned into student property. Now it's a long-term rental. So we've already used 3 different strategies on this property.
Mm-hmm.
You know, we're probably, for that particular one, we're not going to use Airbnb, just location stuff. There's no need to, but I want the property first. I want the asset, and then I'll look at the strategy. So I think that's really what's appealed to us most, and maybe that's why we've stayed in that lane.
Mm-hmm.
And we've just never had a need to go and start using these other strategies. But if we had decided to invest in some vacation properties on lakes in the Kawarthas, well, obviously we're going to look at Airbnbs as a much different strategy versus a long-term rental, right? Just because of the income that we can generate from it. So I'm not against that. You know what you mentioned, fads. You know, I'm not against them at all. It's just we've just had no need for them. But I still believe in the asset first is most important. If I'm gonna, I have to pay this thing off somehow. So if I'm boring to own it and I'm going to rent it out, I want to make sure it's the best possible asset that I can have, that I have the most flexibility with.
Mm-hmm. Speaking of property first, like Rockstar, when I first joined Rockstar, rent to own property first strategy was a massive strategy.
Mm-hmm.
And again, because you ignored everybody else, there was a whole bunch of people saying, oh, tenant first is the way to go.
Yeah.
And I think like a market like now is an example of why tenant first. For example, if a tenant chose a property in a small market Ontario and they left and now you're dealing with it now.
Yeah, but I mean, I think you know as well as I do, like that, you know, there were some numbers were being thrown around early that the buyout rates on tenant first are very high and things like that. And I don't know that ever came to fruition. I mean, I know what people told me, but then I also know the realities I was told at a later time. And that was never the case. And many people were left holding the bag on properties that they didn't want. Yeah. Well,
or the landlord or the tenant.
Exactly. With properties they didn't want. So it's the same thing. Like, you know, and we did that. We called them home hunters, you know, at the time. We did some of that. It was definitely a small fraction of what, you know, versus the property first ones we did. But even when we did that, we told the tenant that we had to find a property that also fit the mold for the investor. And we couldn't buy certain properties. But it goes back to what people are promised. People were promised a solid return, turnkey. No, you don't have to do anything. You just buy this thing, you sit there, and they're going to buy it from you, and here's all your return. And it becomes very appealing to people, right? But then when they looked into it or they got into it and had to, you know, and lived through it, they're like, oh, there's a lot more to this than what we were told, right? And I mean, I'm sure we're not perfect for trying to explain all the ins and outs of investing, but as best as possible through all the classes and stuff, we try to give a real life, you know, situations like, you know, here's kind of what's involved in it. It's not, you know, buy a property, put someone in there, just sit on your couch and do nothing. Even if you have management, even if you have you know, commercial properties with managers in place, you know, that you still need to manage those managers. You know, before we started, I was talking to you about the guy we know with 500,000 square feet commercial in Burlington, and yeah, he's got to manage those properties. He's looking for tenants. Sometimes they have to do work, you know, upgrades to the properties. They even have to, and not just for the tenants that are going in on new leases, but the common areas and things like that, because to attract tenants, you got to make those things nice. So even on that type of portfolio where you can look at him as like a full-time investor, because really that is the business, just owning and renting real estate, there's work to be done. So, you know, so there is some effort to maintain all these properties, but it works out.
Just from knowing so many business owners, even though it's not completely passive, it takes some work. It's been incredibly profitable.
Oh my God!
Like, again, like, you know, because I know lots of entrepreneurs, no different than yourself, you and Tom. You had to put in blood, sweat, and tears.
Oh yeah. 7
days a week. How many hours do you have to put in to manage your portfolio?
I don't. The number's so small. I don't want to say. I don't even know.
That's the point. That's my point.
Once it's up and running, and then there's managers in place, and the systems are in place, it's a small number. But there are times that you're doing some stuff that you don't want to be doing. Like, this sucks, and it's like you can let the emotions get the better of you. But I did do it one time on. It was the same property by chance. It was the same property, the one by Mac that I mentioned earlier. I was sitting in that basement sucking up water from it was. I had the vacuum between the bottom of the stairs and the laminate that was butted up against it, because there's like a little seam there, so I could suck up the water that was underneath the laminate. I was just sitting there. I had to dump out like, I don't know, it was probably like 10 buckets of a little wet vac. So I was going up and down, sitting there running it, and I was like, why am I sitting here on a Sunday afternoon? I was about to barbecue a steak. I was like, I just want to have that steak, go home, But while I was sitting there, I started doing math in my head about, okay, what's this property worth? How much income has it brought in? How many hours have we really spent here? And I forget the numbers that I was running through my head, but at that time I was like, holy cow, this is some of the most profitable time that I can be doing, right? So I'm like, okay, I'm not so bad just sitting here holding this vacuum down here and walking up the stairs every now and again, And I mean, usually it was a Sunday afternoon, so I went down to handle that. But even during most things at that time, someone else can handle that stuff for you, right? But it has been incredibly profitable. I've never looked at it, on an hourly basis for exactly that number, but on an hourly basis, it's been quite profitable. Yeah.
Is there ever there's a period? This is before the pandemic, where your typical house in Hamilton was going up between $2,700 a month to $3,600 a month. So if that vacuuming cost you 2 hours, 4 hours,
yeah,
even at $2,700 an hour, now I just buried myself because I'm not good at math, but that's over $600 an hour.
Yeah,
that ain't so bad.
But it's the emotional side. It's the emotions you're feeling right at that moment. And that's where it's tough for investors, because you have to handle that emotional roller coaster. Because the call's going to, there's never a good time for a tenant to call you and say, hey, I just need this, and this, when do you ever want that call? You never want it, right? But at the end of the day, it's like such a minor issue. But if it comes at the wrong time, sometimes you can feel it's a big issue. But that's where systems, and you're a systems guy, you get it. I mean, it's all, you put the right systems in place and things get handled, and it's not a big deal.
Also, the other way to simply spin it, sucks that I'm getting a call by a tenant, but thank God I have tenants because they're paying me rent.
Look, there's still something to this day that I still like. The one thing from investing that I really kind of enjoy is whenever I sign a new lease, and I'm driving home and I'm just like, it just feels good, because I just feel like that's just an income stream that I solidified for my family, whatever it is. I'm like, that's pretty good. That feels good. Sometimes during student rental season, if you fill 2 or 3 properties in a day, which has never really been hard to do. Yeah. Now during these days, it's really not hard to do, right? But there's been times when if each one is bringing in, what's that, $40,000 to $50,000 a year, call it, or at least at that time. Some of them are bringing in far more now. But if you just fill 2 or 3 year, $150,000 in income that you just kind of shored up for the year, and that day you're like, wow, that's a pretty good feeling.
Yeah, any salesperson would be happy with that day.
Yeah. And there's expenses associated with that. That's not all profit, of course, and that type of thing. But I mean, those are good days. But you've earned them. You've earned them. It's over time that you earn those days as well, right? I don't want someone listening to this just thinking it's like, oh yeah, it's just greedy landlords. It's not about that. You're providing a good place for people to be at. There's a lot of not so good student properties that you were talking about earlier that they could be living at. We're providing a really good, safe, clean, large space for people to live in. We're
top 20% of the market.
Yeah, we're giving them an opportunity, right? So it's you deserve it.
So there's some questions I need to get out of the way before you get going. What are you telling newer Rockstar members, clients of newer people to real estate investing? What should they be looking at right now? And is even now the right time to be buying?
Yeah, I think it's to understand what they want. So what role is it that you think real estate's going to fill for you? You're building a real estate portfolio for what objective? And once that objective is clear, then it makes sense to start looking at what type of investment strategies, areas, properties, whatever the case may be. Then it makes sense to look at those and start building the portfolio that works for you specifically. And this was an early lesson for me. One of my my very first investment property was a flip. I was investing because I wanted enough passive income coming in. At that time, the term passive was, used loosely, but it's
because that didn't take much work.
Yeah. So I wanted enough passive income coming in by the time I was 30 to pay for my mortgage every month. That was my initial goal when I started investing. But then I went and flipped the property. So the strategy I used got me 0% closer to what I was actually trying to do, like 0%. So I'm like, why am I doing this? And that's why I started looking at other strategies that aligned more. Right. So there's two things. There's the financial side of things and understanding what your objectives are, and then going out and building the portfolio properly that's going to match your objectives on the financial side. But there's also the lifestyle component to it, because what are you willing to commit to these properties? We have some people that come in and they're contractors. They're like, hey, look, I want to be able to buy a property. I'll give it a lift. I want the lift that I'm going to get by putting the second suite in, and I'm going to use that strategy because I'll get better cash flow and stuff. But I'm going to do the work, no problem. I have the time. I'm willing to do that. I have the contacts. There's some other people that are like, look, I'm really busy. I'm not a contractor. I have no skills in that regard. Can't do that stuff. I don't want that. I want a different strategy that doesn't require that, and they want something more turnkey. Because they don't want the time commitment there. So different people will have a different amount of time or a different lifestyle they want to lead, and how their investments will fit into that, where some people will self-manage versus some people will get management. And I think those are the important conversations to have when you're starting out versus, well, I think real estate's a good investment, so I just want a property. Let's go find one. What's a good one? Right. I think that just a little bit of thought beforehand can kind of go a long way when you're building things out, and it makes a difference. It almost, that thought early on will compound the return over time, and when you look back in 5 or 10 years, it makes a big difference.
What about some markets you like? Look at some neighborhoods or towns that you like.
I like any self-sustaining area. I don't like the bedroom communities as much. So usually the self-sustaining areas, meaning there's going to be jobs in the area, and they don't have to travel for everything they want. Good employment there. Obviously there's other things we like public transportation and infrastructure and population growth. There's all that type of stuff too. But in a nutshell, it's a self-sustaining area. So areas that have the employment, because that draws the other things generally. So for a long while, Milton was just a bedroom community of Mississauga. There is more jobs and things and more development stuff that has gone on there, in recent years. But for that long while, I would be less interested in investing in Milton versus a place like, Mississauga, as I used the example, or even like a Hamilton at that time, Kitchener, Waterloo, Cambridge, which is right down the 401 from there.
They all have way more jobs than per capita up in Milton.
Exactly. So they're self-sustaining. Well, sometimes that's going to cost me more. Is it going to cost me more to invest in Hamilton versus Welland? Yeah, I'm going to pay a premium to invest in the Hamilton area, but I feel like I'm getting something for that premium. I'm not just paying more because it's in Hamilton. Yeah, I'm buying everything around it. Yeah, I'm buying the economic activity of that area. So anything that really has, is self-sustained, what I consider a self-sustaining community that way, I'm more interested in. Having said that, I just the one I have to close on in a few months is a new construction in Oakville that I don't know. It's not it doesn't really match that as well, But that's for my kids. That's not for my kids to give to them. The idea with that was to plan to buy this property close to home, because I'm going to drag my kids there to manage it. I want them there at the beginning picking blinds. I want them, meeting whatever other contractor we have to meet there. If we have to go meet the cable guy to set up the internet the first time, I want them coming with me so they see what's involved with it. I want them meeting the tenants when we go to show the property. And the idea is that whether they decide to ever invest in real estate or not, I want them to understand the way it works, so they know how there's just different opportunities in life. And then the way I'm bribing them is I'm like, guys, if you help me with this and you're involved in this process, they basically will get half that property each. Because the way I look at that is that's their foot in the market. So they're 9 and 12, so we have lots of time. But it doesn't matter if the market goes up, down, or sideways. This is their foot in the market, and then they can leverage that however they want. So if they have half a property that's pretty much paid off by the time they're looking for their own property, that property they can sell that, take that half of their cash and go and buy another property. They can leverage it, keep it, rent it out, buy their own property, but that is their foot in the market today. That's the way I'm looking at it. That's how I'm trying to bribe them. I have no idea how that's going to go. It could be a disaster. It could be I could fall on my face with that one. But that's the idea. It sounded good at the time when I bought it.
I've taken my kids to my Hamilton properties.
So yeah, I've taken mine too. But this one I'm like, I want them there for everything. so that's why I have to be close to home. So it's like 3 blocks. It's about a 5-minute drive. So there's no real complaints other than like I just want to hang out with my friends. I'm like, your friends can wait for to get there.
Bring them.
To get there, meet someone, and come back is like a 30-minute thing. It's like, and there's a Dairy Queen on the way. If I have to bribe them with Dairy Queen as well, I'm going to do that too. Whatever I need to do.
The funny thing is, like, if I have any listeners over the age of 30, they're like, I wish Nick would adopt me and make this my problem.
Oh, jeez. Yeah. Oh, trust me, there's other things that probably don't do so well, I'm sure.
Because you and Tom have mentioned this in our meetings a long time ago. Like, I remember always you referenced like European cities where anyone young, they don't buy, they rent. There's never an opportunity to buy unless you had family wealth, like significant family wealth. And that's kind of been a story here in the GTA Golden Horseshoe for probably around the last decade or so, and especially now. Yeah,
and then real estate is left to the family, right? That's how it works. And sometimes the family decides to sell it and they squander the money, or they do something worthwhile with the money. And then sometimes they decide to hold on to it and they leverage it for future things. But I can't find an argument that makes really good sense to not own assets in your life, because I really feel strongly that you own the assets and you leverage against the assets gives you much more opportunity. So you continue to build that asset base versus cashing out. Mm-hmm. And it's we've seen it time and time again. Like that's how you're really able to then, you need a cash flow component because you have to pay off that leverage. So you need cash flow to support the leverage that you're getting on those assets. But if you have that, that's what allows you to go
elaborate on where cash flow is coming from? Business, employment?
Yeah. Anything, as long as you can pay for it. So like, I won't use a real estate example, but we'll use a stock example. When I was actually at Oracle this time too, I was there just for a period of time. Tom spent more time there, but Larry Ellison was getting a big billionaire, right? And it was talking about this credit line that he was getting to do whatever he was doing. I don't know if it was NetSuite and Salesforce at the time, or whatever the case might be. And I'm like, why is this guy getting a credit line? Like, he's got lots of capital, but he would use the stocks he had as collateral. And then instead of selling the stock and cashing out, he would then borrow against it and then use it to generate other income, and then use that income to pay that back. And now he had the new assets and he had the old assets still. And I was like, holy cow. And like at that time it was mind blowing to me. I'm like, oh my God, this is a guy that has bucket loads of money, but he doesn't get rid of the asset. He keeps the asset and you leverage the asset to do other stuff. And I'm like, wow, to me, that was just mind blowing. I'm like, I get it. Like, I totally get it. And that's the beautiful thing about any assets, real estate specifically, because it's very easy to leverage, but you need, whether it's business income, rental income, employment income, you need that to pay back the leverage that you're getting, right? So that because if you over leverage and you don't have the income, then you're in a bad situation, right? So you got to be careful with that. But I feel like it still can be a powerful strategy, even with the rates are a little bit higher. Like, they're still low historically, right? So, but yeah. So I think that's the way I look at things.
You mentioned the term, like, you need to be able to survive. You need the capital, cash, whatever, to get through this. How long do you think this, whatever we're in, lasts until things change? Well, just for example, say, Nick, things are rough. I'm negative $200 on each of my 5 properties, so I can weather it.
Yeah.
How long do I have to survive?
Yeah, I mean, I don't have a crystal.
I know you don't. Nobody does.
Let me start with that. I feel really strongly that we're in the eye of the storm. I think there's going to be a little bit more pain to come, not necessarily in the real estate market and the economy. And I think that pain comes, I think it comes this fall. I could be wrong, but I think it comes this fall or early next year. And then I think there's going to be a policy response to that. And because because of the amount of debt in the system now, if they allow that pain to be prolonged or too much for people, it's not about your $200 a month and other people that are kind of, having cash flow situations at home and worried about going to the grocery store. they're less worried about that, more worried about the banks will have real problems, because the banks are so leveraged that if there's real problems paying back funds, or if real estate starts to change course in a large way, the government has to step in, because it just the whole system basically is at risk because of the amount of debt. This isn't a situation we were in the past, because some people will look at today's market and be like, oh, it's eerily similar to, like, you know, the late 80s, early 90s. And they're right in some ways. I don't believe they're right in some other ways. And some other ways are definitely not right in the amount of debt that's in the system. And I think that really impacts things. The amount of debt that's been put in the system, so the amount of inflation that's been happening that's contributed to price levels as well, hasn't been really accounted for in a lot of those arguments. So I think that there's a policy response that comes in, and that's where things get a little bit ridiculous. And I think a lot of that money that comes in to short things up, I think you start seeing asset prices do strange things. Like, I think you start to see aggressive price moves upwards in asset prices. I'm not talking real estate. I'm talking, there's a lot of correlation with the amount of liquidity in the world. So that's kind of like money creation and printing. There's a lot of correlation with that and asset prices. And when those floodgates open and that comes rushing in again, I think we see a spike, and then I think there's got to be this policy response to try to bring it back, and they try to draw that back down, and we kind of see things go up and down and teeter-totter for a little bit. That's kind of what I think, based on some, you know, past history charts and the different decades that we've seen environments like this shaping up. So, but I really think there's a little bit of pain coming. I don't know. Maybe it's just what I'm preparing myself for, because I'm just kind of staying more liquid, keeping more cash than I would have typically kept on the sidelines, so that, you know, if it needs to be deployed in certain places, it's available. Because we have the business to worry about. We have payroll to worry about. You know, you as a business owner, at least, I think you would feel the same way. You feel some responsibility to that. So it's not just us. Like, we have to kind of take the whole picture into account. So we got to we got to think about that stuff too and plan accordingly.
Anything else besides being more liquid, holding more cash? Gold, silver, Bitcoin, Ethereum, Dogecoin, whatever other.
Look, I'm the worst trader in the world. So if you're looking for anything, I'm assets. I'm the old, like the old school, boring asset guy. Buy a property, hold it for a long time, and rent it out, leverage that, buy another one. I like gold. I like Bitcoin because you can own it. I know some people think that's ridiculous. I like the finite amount of it.
But you're not saying own an enormous amount of Bitcoin.
No, I mean, whatever you're comfortable with. You know, whatever you're comfortable with. I just think I would prefer to keep my savings in assets that I feel are an inflation hedge. So real estate has served very well as an inflation hedge for me in my life. You know, Bitcoin has been far more volatile, yes, but from when I got involved in it and you know, through some multiple purchases, it served very well as an inflation hedge for me. Gold has served well as an inflation hedge for me as well. You know, maybe not it hasn't exceeded it as much as like real estate has and things like that. But, you know, is it getting ready for a move? It could as well. But I just like those types of assets that I can hold. So anything that I feel is like that quality of an asset, I'm willing to have. But yeah, I think you've just got to be a little bit more prudent. And maybe in the past, if you thought that you could invest for the shorter term, if you're looking at shorter term things because of what might happen in the economy, it might impact exit plans. So if we get liquidity events, meaning like where it dries up, so lending gets harder, and you think that you have a property that you're going to be able to exit at a period of time, you might not be able to. So if you're investing for the short term, you might want to also, as on top of staying a little bit more liquid, expand your time horizon in case you can't exit when or how you want to. What's the backup plan to that? And I think it's always important to have that backup plan and make sure that that's suitable for you as well during times when it's like very likely that we're going to be in a recessionary time, and you know, there'll be a little bit of, you know, there'll be less money sloshing around for a period of time.
Yeah. And that would include getting a more difficult time getting financing on anything.
For sure. Yeah, 100%. Yeah, anything that applies to real estate really applies to a lot of stuff. I'm just a real estate guy. It served me well. But you can do that, like, you can do it with other things as well, right? Businesses is like businesses are no different. Like you can buy business, you can leverage against the income a business generates, buy another business. Like there's all sorts of things you can do. It's just real estate seems to be the most accessible for people, and it's like a business in a box because there's very little marketing needed for the clientele to be attracted to the product that you have. Right, for real estate, especially where we are right now, right? Because we're like supply demand is totally out of whack.
Yeah, throw up a Facebook Marketplace ad and you're flooded.
My gosh, yeah, it's it's a little bit it's like unhealthy in a way, right? Yeah, we don't.
I'm so sad for this generation.
Yeah, we don't want it. There's got to be a little bit more thought put into. I'm not anti-immigration at all, but I mean at this point, like there's got to be a little bit of thought into it. Like, hey, when you're going to do this immigration policies, how about you think about roads and hospitals and housing? Like, don't you think those should be part of the equation versus just some random number? It seems like you're picking out of a hat.
And the international student number, but yeah.
Oh yeah. The non-permanent numbers are ridiculous. Well, it's basically the universities, if you think about it, and maybe you've already thought about it like this, but the universities are dictating our immigration numbers, right? So these are for-profit universities. Kyle just did a chart. You should see it. The average tuition, maybe he did it or shared it. I don't know if it was from someone else, but the average tuition for a Canadian student, versus the international student, the international student has jumped by about over the last 5 or 6 years by about 30-something%, and the Canadian students have stayed about level, right? And not to mention the numbers. So we're doing a little bit more research into the programs they're going into and stuff. We're going to release a report about it, but so the universities have their targets. They're recruiting overseas. There's no mandate for them to tell the government how many of these non-permanent residents are bringing in.
Because there's no cap. They're not regulated.
Yeah.
In terms of how many students they can bring over.
They're the ones dictating our immigration numbers. It's not even the government. Those are just the permanent resident numbers. Mm-hmm. Like it just makes no sense at all. There's no thought going behind this at all.
Well, it was our provincial government that put the caps on tuition for domestic students, though. So schools have no choice.
Yeah, well, if they're going after the profit, yeah.
They've even just to survive. But just like us, like we've had rent caps implemented on us, rent control.
Yeah.
How are we supposed to keep up?
Yeah, you're talking to an ex-government worker that I saw when you talk about the amount of budget being used and where it could be allocated. I'm a little bit jaded from my past life as a regional employee, right? Because I think that through efficiencies, there's a lot of money that could be saved.
Good. So we can cap property taxes too, then, right?
We could look. There's a lot to. I don't know. Find something the government got involved in that's helped with the prices and helped keep them down, and there wasn't a lot of waste put anywhere.
Well, that's a slippery slope.
Just go down the slope. Just trash them. No, I'm not saying there's no need to trash them. We all know what's going on, but it's crazy. It's nuts when you think about it. Like it makes no sense.
It actually makes me really upset a lot when you go down and like ask questions and dig into all this sort of stuff. It's actually hard to maintain a healthy mindset.
Have you seen the hiring chart over the last few years?
Oh yeah, the federal.
Yeah,
it's ridiculous.
But but think about this, right? So the central bank's raising interest rates. One of the big things that they're waiting for is the unemployment number to come down. To go up. Okay, they want so first of all, just think about that. These are like, well, they're not elected, but the elected officials kind of place them there. So this is like a kind of national institution that is saying that Canada, we want unemployment to go up. So just think if you're someone that's employed, you're like, okay, great. So you're looking for some of us to lose our job. Like that's your stated goal. So if that's not problematic enough, the federal government, they've been on this hiring spree. They're outpacing anyone else. And the Trudeau government is far above any previous government in the number of people they've hired, right? So the Bank of Canada is waiting for unemployment to go up, but yet the federal government keeps hiring all these people, keeping the unemployment number low. I'm like, isn't this it's almost like they're working against each other.
They are. Yeah.
Right?
They're stimulating the economy.
It just makes no sense.
That's basic economics. You're stimulating the economy by putting more money in the system.
As you're trying to slow the economy.
Yeah, as you're trying to slow the economy by raising interest rates. It makes no sense.
Well, hey, you said it.
It'll balance itself, Nick.
Yeah.
We'll stay mentally healthier.
I have more important things to think about than that, Erwin. Okay. Do you remember that speech? You forgive me if I say that I'm not thinking about like monetary policy. I have more important things to think about. That was something like that. And that wasn't an exact quote, but it's not far off at all.
We might be happier people if we just accept that.
So, look,
but we're not happy. We have all those gray hair.
Our prime minister can take the best selfie in the world. I'm convinced. Okay.
It's a damn good selfie.
Yeah, I know. So look, at least we're global leaders in something.
Yeah.
Are we ending on that? I hope we're not ending on that.
No, we're not.
We got to say something. We got to say something else.
No, because then let's get more upset. Nick, where can people follow along? Because I know you have a really popular podcast. I've been recommending the Rockstar Inner Circle. Well, when I have like a novice investor that wants to learn about real estate, and I'm a value investor. I believe in only paying for valuable, what I consider good value real estate trading, for example. So I've recommended clients to Rockstar Inner Circle.
Yeah, we appreciate that for sure. But yeah, only if it's right for someone. So yeah, if anyone just goes to rockstarinnercircle.com, they can find all sorts of videos, articles, like anything they want there. And podcast is the Your Life, Your Term show. So we cover real estate stuff and investing, macro stuff. We just had we just had a jeweler on the show today.
What's he saying?
These are Kalani Jewelers. Do you know Kalani? They do all the jewelry for a lot of the NBA guys, MLS guys. They've created like a kind of they've created pretty much like a global brand for themselves. And a lot of the soccer guys flying to town to go see these guys. It's a very cool story, and when you see some of their pieces, it's crazy. So we do, I guess the point of sharing that is we do a variety of different things. It's not just we don't just do real estate. So we try to talk about a bunch of different stuff that just interests us in general. So
I find with almost anything, there's something to learn from them.
Oh my gosh,
they deal with the high-end market.
Oh, these guys do their back room with all their custom pieces are just outrageous. But a lot of the hip hop guys, Raptors, Blue Jays, a lot of the NBA guys, when they come into town, will go there for their pieces. And some of them they can share their names. Some of them they prefer to keep it quiet. But yeah, really cool story. Really cool story. But there's always lessons. Yeah. I mean, these.
I'm gonna guess they're not really feeling a recession.
So, no. I mean, I think there's everyone's feeling it just to different extents. You know what I mean? There's so everyone's feeling it a little bit, and just the inflation numbers too, because they're trying to open up other stores in different cities, like they're opening up a store in Miami.
Okay.
And there's the same forces impact everyone.
Right. So as business owners, I'm just more interested in how does their clientele feel any?
Yeah, the very high end doesn't feel it. They're not impacted, right? But I mean, when there's more money in the system, there's also more people going into a place like that that are spending money that wouldn't be spending money otherwise. They're not buying the $150,000 or $250,000 pieces, but they might be buying something worth $5,000 to $10,000 that they wouldn't be spending that $5,000 to $10,000 now.
Again, just like I always find, there's something to be learned from everyone. Versus I have a friend who works at Spence Diamonds. Maybe I shouldn't name them. He works for a jewelry company in Square One. So I asked him, how's business? And just to get a gauge for what the retail level is like. But it's kind of funny still, because I remember him telling me a 1-carat diamond ring is a 1-carat diamond ring. Doesn't matter what it costs, they're buying it.
Yeah, if it's an engagement ring, I think maybe
that's fascinating. Human psychology.
Yeah. But I think I don't know if this is true or not, but I think the other pieces, if you're looking to get married and you need an engagement ring, you're going to buy an engagement ring. Yeah, right?
Doesn't matter what it costs. That's fascinating.
But the other pieces, I don't know. I think things might be maybe there's less diamond bracelets going out the door. I don't know.
That's what he's saying. Yeah. The other pieces there's less demand for. Yeah. So just to give, again, I'm just looking for insight into how the market is.
For sure, I love talking. I'm always asking people in different industries, right? And I haven't spoken to a single person that isn't saying on on their everyday life they're seeing differences. I feel like the recession has almost started already. It's just we're just seeing it on the streets now. We just don't have the backwards looking data that the government's looking for yet. But everyone's feeling it. I mean, how can you not? This is a historic pace of interest rate increases. We've never done this before. Everyone's feeling it. There's just no way not to.
Nick, thank you so much for doing this.
Oh, dude, I appreciate you having me on.
Yeah, thanks so much for the honor. 300 episodes.
Yeah, that's something, man. That's consistency.
Like you said, you always said it. You always said it from the beginning, back into 2010. Just be consistent.
Yeah, but it's the hardest thing to do, I think.
That's what people don't think. Yeah. I'm just going to start a podcast. Yeah. I forget the number is how many podcasts actually go beyond 6 episodes.
Oh, I don't know, but it's probably not a lot.
I bet you 80% don't make it past 6 episodes.
Well, we get a lot of people that will say like, "Hey, I'm going to start the weekly email.
Yeah.
And I'm like, "Hey, don't start weekly. You can always ramp up to weekly because if you start, I mean, you can if you want, but when you start weekly, it's easy. It's easy to fail because the next week it comes quick, you know. So, congrats to you, man. Congratulations on making it, right? And not just that, really everything you've done to this point, right? You've always been an implementer. You've always implemented a lot of different stuff, and you've always, so it's kind of a testament to you for kind of doing all that stuff.
I haven't been so good at sticking with CrossFit like you got me going into. And I'd like to thank you and Tom and Nick for the mentorship because you've given us a lot of great ideas that was backed by hard data. And so, without good coaching and mentorship, we wouldn't have gotten this far.
Oh, cool, man. You and Sherry are awesome, so we like it.
We'll end it there.
Thank you for watching. If you want to learn how to invest in real estate from scratch, my team teaches beginners how to use the #1 investment strategy that I personally use in a virtual free training class every month. Go to investortraining.ca/YouTube to register for our next class. The link's also in the description as well. I publish at least 2 to 3 videos a week here, so subscribe if you want to keep learning from seasoned investors like myself and my guests. And if you're just starting out, feel free to ask questions and comment below, and I do the best to answer each of those comments and questions myself. Again, if you're ready to learn the nitty-gritty about real estate investing from a professional investor, register for our next virtual class. That's at investortraining.ca/YouTube. Thanks again for watching. See you in the next video.